Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot. But before we start talking about the income pick, I want to let you know that anything you hear in this video is for information and educational purposes only. Nothing in this video should be taken as personalized investment advice. Investing comes with risk. No matter how safe an investment sounds, there are risks involved. To read more about it, please see the description below. In this interest rate sensitive environment, it continues to be a great time to look at business development companies, or BDCs for short, including today's income pick, PennantPark Investment Corp, traded on New York Stock Exchange under symbol PNNT. Why is that, John?
Well, real estate investment trusts, or REITs, are a great way to invest in properties without the hassle of needing the time and money to actually own property and be a landlord. If, on the other hand, you want to be a private equity investor but don't have the cash to drop millions of dollars into middle market companies, then you might want to consider a BDC. BDCs provide capital to private firms that need cash to expand their businesses. Because they're private, you and I can't invest in them on our own, but BDCs, by their very structure, can. They're actually created to invest in small and medium-sized privately held businesses. And because they have really deep pockets, each BDC will invest in dozens to hundreds of private companies. And there are a lot of private businesses looking for a cash infusion. From 2002 to 2021, public BDCs have ballooned from $5 billion in assets to $200 billion in total assets.
And John, how does that help income investors?
Well, most BDCs use floating rates for their debt in their portfolios. And in this interest-sensitive environment, it has helped juice their bottom lines. And because astute BDCs are good at finding excellent companies to invest in, they have a low default rate of just 1.64%. And like REITs, business development companies legally have to pay out at least 90% of their taxable income to investors as dividends. And the yields can be quite high, averaging 10.7%. That's far superior to the S&P 500 average dividend yield, which is just 1.54%, and far above master limited partnerships, 7.8%. And even junk bonds, which have an average yield of 8.3%. And today's top income pick, PennantPark Investment Corp, has a 10.98% yield. Better still, it's raised its dividend for the last 7 consecutive quarters. Starting in October, though, it will be changing the frequency of its distribution from quarterly to monthly.
John, tell us a little bit more about PennantPark Investments. What does the company do? What kind of companies it invests in, and so on and so forth?
Yeah, PennantPark is a private equity firm that focuses on middle market companies.
John, hang on a minute. Why the middle market companies?
Good question. The U.S. middle market includes nearly 200,000 companies, and it generates $10 trillion of annual revenue. That's 1/3 of the entire U.S. economy. As a standalone, it's the world's 5th largest economy. Its core focus, PennantPark's core focus, is U.S.-based companies, where it invests between 10 million to 100 million across the capital structure. And that includes different types of loans or debts, like senior secured loans, subordinate debt, and other types of investments. And it invests that in companies with EBITDA of 10 million to 50 million. And as noted, it invests in the form of senior secured loans, mezzanine debt, and equity investments.
And I know for a fact that not all debts are created equally. So it's important to know what the different loans mean and how it will impact PennantPark portfolio should a company default.
Yes, exactly. For instance, a business development company with a lot of senior debt stands first in line to get its money back. Mezzanine lenders get paid second. Meanwhile, preferred and equity investors usually receive only a fraction of their original investment, if anything at all, in the event of a bankruptcy. As for PennantPark, as of June 30th, 2023, its $1.07 billion portfolio consisted of 590 million of first lien secured debt, around 95 million of second lien secured debt, and 155-ish million of subordinated debt, and 236 million of preferred and common equity. But what's important also to know is that its debt portfolio consists of 96% of variable rate investments and just 4% of fixed rate investments. And you were asking what some of the industries or companies they invest in. They tend to target companies in the healthcare, consumer products, financial services, telecom, aerospace and defense, buildings and real estate, hotels, gaming, leisure, insurance, pretty much anything I think that they think they can make money on.
And PennantPark reported a third quarter earnings and revenue beat. You can explain a little bit about financial situation here?
Yeah, they're good at making money, which you'd expect or hope from an alternative bank. For the third quarter of fiscal 2023, which ended June 30th, PennantPark announced revenue, or what they call investment income, was up 93% at 45 million. Year-to-date investment income rallied still an impressive 46% to 111 million. Fiscal third quarter net investment income came in at 23 million or 35 cents per share. That's up from 16 cents per share a year ago and top Wall Street projections of 29 cents per share. Now, during the third fiscal quarter, the company invested roughly 70 million in 3 new and 43 existing portfolio companies at a weighted average yield on debt investments of 12.6%. For comparison's sake, in the third quarter of last year, it invested 326.3 million in 11 new and 36 existing portfolio companies at a weighted average yield of 8.7%.
And you rarely see these kind of increases, but this BDC increases quarterly dividend by 40% year over year.
Yes, strong cash generation resulted in a number of increases to PennantPark's quarterly distribution since the start of 2002, 7 increases so far. Most recently, on August 9th, the company declared a quarterly distribution of 21 cents per share, or 70 cents on an annual basis, for a yield of $10.98. Yeah, most recently, this past August, the company declared a quarterly distribution of 21 cents per share or 70 cents per share on an annual basis for a yield of 10.98%. That's more than triple the current inflation rate of 3.1%. 21 cent per share payout represents a 5% increase over the second quarter of fiscal 2023 and a 40% increase over the 15 cents per share paid out in the same prior year period. Now, as previously noted, PennantPark is switching the frequency of its distribution from quarterly to monthly beginning in October, and frankly, most shareholders would rather get paid monthly than quarterly. For now, the company's 21 cent distribution is well covered by its net investment income, which was 35 cents per share in the third fiscal quarter.
At the moment, PNNT shares are around record levels, but could there be more upside?
Yeah, absolutely. Strong financial results are helping send PennantPark stock higher. In fact, on August 10th, its stock hit a new all-time record high of $7.07 for a year-to-date gain of roughly 30%. Now, Pennant stock has retraced a little from that record level, but it's still trading up 22% over the last 3 months, 23% year-to-date, and 13% year-over-year. Now, those are solid gains, but Wall Street sees PennantPark shares climbing even higher over the coming quarters, with analysts providing a median 12-month share price target of $7 and a high estimate of $8 per share.
John, thank you so much for your analysis. PennantPark Investment Corp is a great BDC that is good at making lots of money and providing investors with ultra-high dividends. It reported third quarter earnings and revenue beat, raised its quarterly dividend, and its stock price just hit a record high. Going forward, the company's earnings stream remains robust, which should help it continue to reward buy and hold investors the frothy monthly dividend. That's it for today. We'll be back with another video soon, so stay tuned. In the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.